Today I'm going to give you three key messages, and the first is why we think we're going to have the worst default cycle here in Australia since 91 and in the US since the GFC. The second key prediction is that we think simple old risk-free cash, risk-free government bonds and near risk-free bank bonds are going to outperform equities over the next few years. And then finally, we recommend avoiding illiquid assets like the plague. So the first challenge that I want to raise is we have an inflation crisis, and that inflation crisis is being driven by a productivity crisis. We have the worst productivity in decades. Labour productivity is running negative 3.5% year on year, and this is powering a lot of inflation, as you'll discover in a moment. The problem is that productivity is measured as output per hour, and businesses are carrying too many people for the products they're producing. This is manifesting globally very, very low unemployment rates, and you can also see it in the counterfactual. Think of Elon Musk waltzing into Twitter, sacking 80% of the workforce, but he still produces the same services. So this really poor productivity is showing up in super elevated unit wage costs. Now, unit wage costs are what central banks use to forecast inflation, the key forecast variable in their models. Here in Australia, they're running at about 7.5%, the highest level in decades, and we're seeing similar dynamics all over the world, in the US, Europe, and New Zealand. Now, unit wage costs are nominal wages less productivity. And for the RBA to hit its 2 to 3% inflation target, these unit wage costs need to be down around 2.5%, not 7.5%. And there's no sign of any change. The only way to really change it is through a massive increase in unemployment. When we decompose Aussie inflation, we find that the culprit is indeed these unit wage costs. So the key driver of inflation today in Australia is elevated wages coupled with persistently poor productivity, and that's also showing up on the demand side of the inflation data. So if we look at demand side services inflation, in Australia, the US and Europe, we see all the same problems of sticky, stubborn, recalcitrant services inflation running at about 4 to 6% a year, and this is likely to power ongoing core inflation that will be multiples the central bank targets. Now, yes, we have had big increases in interest rates, and yes, we're seeing cracks starting to appear. But please note this, the RBA is not forecasting it will return to its 2.5% inflation target until 2026, literally years away. And maybe one reason is because their cash rate's at 4.1%, but they say the normal cash rate is 3.8. They do not have policy in restrictive territory according to their own modelling. They do in the US, which is why we're seeing some of the stresses materialise in that economy. But another key fly in the ointment is when we shut down households and communities during the pandemic, we stopped them spending, right? At the same time, we gave them record amounts of cash. And this has led to something we've never seen before, these unprecedented consumer saving buffers. We estimate in Australia they're worth about 20% of annual income, and they are delaying the hiking cycle in terms of its impact on consumers and households, allowing them to resist the impact of rate hikes. You can see actually this is Fed data. The green dotted line on this left-hand side is the Fed's measure of the Aussie consumer buffers, which are among the biggest in the world. Our data suggests the US consumer will deplete their buffers later this year. The Aussie consumer, however, will not deplete their buffers until sometime late next year. Central banks are not going to cut rates aggressively. Markets think they will, but markets have been consistently wrong. Markets were pricing 100 basis points of cuts for the Fed this year, and that's been eviscerated and shifted into next year. Because central banks are really concerned about repeating the mistakes of the 1970s when they cut rates too quickly, only to see inflation rebound very, very rapidly indeed. Now, these high interest rates, or so-called high discount rates, that are used to value all asset classes, so to price equities, property, venture capital and private equity, pose a problem for their valuations. And when we look at cyclically adjusted price earnings multiples for the S&P 500 over the last 140 years, we're currently sitting at 31 times. The 140-year average is 17 times. The median is 15 times. So equity valuations look rich. And then when we analyse the relationship between core inflation and equities in the US, PE multiples are actually inversely correlated with core inflation in the US. And at a 4 to 5% core inflation rate, US S&P 500 cyclically adjusted PE should be around 15 times. They're obviously north of 30 times, implying that inflation is not a problem, which we think it is. And then when we look at the forward returns from S&P 500 exposures, once the PE multiple pierces 30 times, we find that they're demonstrably negative in every period, particularly when you adjust for inflation. So future returns from equities, once you reach these valuation heights, look very, very unattractive. Another way about thinking about equity valuations is using the equity risk premium model, looking at the extra return you get from equities above risk-free government bonds. And here, using the Fed's model, we find again that the return premium you get from equities over the risk-free rate is 25% smaller than it normally is, which again poses real questions for valuations. We also have this tremendous new innovation, the rise of these zombie companies. So 10 years ago, only about 5% of global listed companies were zombies. These are firms that don't have sufficient income to pay the interest on their debt. Today, that's about 10 to 15% of all listed firms. And we're using FY22 data. If we were market to market today, it'd be much worse because we've had much larger rate hikes since that time. But the cracks are already appearing. We're already seeing the emergence of the biggest default cycle in the US since 2010. So bankruptcy filings year to date are the worst since 2010. And this is very bad news for non-bank lenders in particular who are lending money to these riskier borrowers. And we're seeing recovery rates on senior secured loans in the US drop to their lowest levels ever. Normally these recovery rates are about 70 to 80%. Right now they're running at 25% year to date, probably because these non-bank lenders extended money to companies on massively inflated valuations. Here in Australia, we're seeing a huge increase in insolvencies. We're already back to 2016 levels. This has been driven by commercial real estate construction and residential property developers in particular, the key sectors focused on by non-bank lenders. And then if we look at home loan delinquencies between banks and non-banks, the top blue line is bank home loan non-bank home loan delinquencies. The green line is bank delinquencies. This is the 30-day arrears rate. We've seen a massive increase in arrears amongst non-bank loans, but very little increase on the banks. And this really kind of betrays the fact that a great deal of credit risk shifted out of the banking system after the 2008 crisis and went into the non-bank market. So the non-banks are holding most of the credit risk. Just to conclude, the existential challenge for asset pricing today is these hurdle rates, these discount rates or risk-free rates. On risk-free government bonds, you can get 4 to 5% interest rates today. On cash deposits, you can get 5 to 6%. On relatively risk-free bank bonds, you can get 6 to 7% interest rates. And these are the new hurdle rates for all investments, which should be paying 3 to 5% risk premium or above them. And yet, if we look at A-grade office property, still yielding 4.5%, residential property yielding about 4%. If we look at Aussie equities, even grossed up for franking credits, yielding about 5.7%, which is just not enough. So our expectation is you're going to see onward, downward pressure on asset prices until they offer sufficiently high returns above these hurdle rates. So in summary, we think the low rates for long paradigm is dead, as is the search for yield. We can welcome the rise of attractive risk-free yield. We think we'll have the worst default cycle in Australia since the 91 recession, and that cash and government and bank bonds will outperform equities over the next 2 to 3 years. And then finally, we think you should get short illiquidity, which you should avoid like the plague, and long liquidity to benefit from the optionality that gives you to capitalise on future dislocations. Thank you very much.
Thank you and good afternoon, everyone. I know it's been a long day, so hopefully my prediction will be light, less details heavy. I'm very excited to share it with you. Sorry, that was a compliment. Before I give you my prediction, I wanted to share with you what shocked me the most when I arrived in Sydney from London back in 2012. It was price of tomato. It was $9 per kilogram in Sydney, while in London at the time I could get it for 99 cents. So that's how my hyper-focus on Australian food price and Australian food inflation started. And today, my prediction is that Australian food prices will continue rising beyond our expectations. Beyond our expectations, so we're now at about 7.8 when we talk about food and non-alcoholic beverages CPI. Some econometric models predict it will go down to 1.5% next year. I predict it will trend at about 9% at the end of next year. That's my younger son, Enzo. He loves grocery shopping. He's a bit older now, so we talk about prices, and you know, how you have to actually work in order to buy something. But the question to you, who knows how much they spend on grocery shopping per month? Oh, okay. Quite a few. Enzo knows, so it's about $864 per month on average for an Australian family. And it's about 60% increase compared to last year, 60% increase. Now, we all know we're living now in high inflationary environment. That's not surprising. What's interesting, if we look at this chart, we see that this trend is not a new trend. It's not short-term trend. And we heard today, I'm sure, many times, the term sticky inflation. That's what everyone is talking about. Now, from my perspective, it's also about understanding what are the factors, why is it happening. In my opinion, 3 factors worth considering. One, very challenging geopolitical environment globally, disruption of supply chain as a result of this, increasing transportation cost and rising commodity prices. Second, more frequent and more extreme weather events. When I talk about climate change, sometimes people say, what climate change? So I'm not saying climate change, but I'm saying more frequent extreme weather events. We cannot deny that this is happening. As a result of this, also disruption of global value chain. Not going to go into details on this, but happy to talk about this separately. And finally, we're talking about scarce resources, scarce land and water resources. So few weeks ago, there was an article in AFR, excellent article, I love agriculture, saying that Australian farmland is or has been a quiet achiever. Why? Because it outperformed equities, sorry my equity colleagues, it did outperform equities in Australia and globally over 1, 5, 10, and 20 years. If we look at this chart, the trend line, you'll see that price for Australian farmland per hectare increased by about 195% over a decade. I'll add to this that value of water entitlements in Australia, water entitlements allocated to irrigators, increased by 250% over the same period. Now, as an asset class, agriculture has low, sometimes negative correlation to most asset classes. It has embedded inflation protection in its investment return, and it can deliver fairly stable, well, we can see here the value, fairly stable capital growth over a longer period of time with income. Fascinating asset class. When I look at all this, I ask myself, what are the long-term tailwinds that are supporting these trends, that are supporting this picture? And to me, it's very simple. Global population will continue growing. We hit 8 billion mark well ahead of all predictions. Secondly, we are talking about very attractive investment environment in the Australian market. And I added here, oh yes, the Costa Group article in AFR again. Costa Group last month announced that they're likely to go private. There will be probably some other businesses who'd follow and partner with a global private equity group. There will be more foreign investors coming to Australia, buying farmland, buying agriculture businesses or agriculture assets. That's just inevitable. It will be all happening. So what does it mean to you as investors, this prediction? What does it mean? I can share with you what I do as a portfolio manager, invest in alternative assets. And water rights, water entitlements, and investments in agriculture assets account for over 25% of my portfolio. And that's not all. I can also invest in this trend via private equity. I chose few examples here. Retail Zoo, probably many of you are familiar. It's a business that owns food chains such as Betty's Burgers and Boost Juice. And Birch & White is a Sydney-based manufacturer of condiments and desserts. So if you are already spending today 60% more on your monthly grocery shopping, I suggest you look into investment opportunities and think how to tap into this very attractive long-term theme that is going to stay here for a while. Thank you.
Good afternoon, everybody. Great to see so many people here today. In fact, it's a little surprising because if you're like me, almost everyone you know is on holidays in Europe or Bali, enjoying their time in the sun. Well, my shocking prediction today is that the sun is setting on international travel boom and prepare for a crash landing. After an intense period of revenge travel, it's clear that the leading indicators are rolling over. Looking at the US, which is a good guide for Australia, given they're about 6 months ahead in their reopening, we can see there was a strong recovery post-COVID, but sales are now starting to roll over. Sales with airlines in the June quarter declined quite sharply, and that's a similar trend we're seeing at online travel agents as well, with Expedia reporting a 7% decline in their gross bookings and Airbnb a 6% decline in what's meant to be the seasonal peak for travel in the Northern Hemisphere. Airfares are showing a similar trend here. We're now well below the 2022 peak, and airfares are on track to go below the 2019 level soon. But probably my favourite indicator that we're entering into a slowdown is the wait times at Disneyland. Prior to the pandemic in 2019, the average wait time was 37 minutes. This year, we're at 24 minutes, and that equates to a lot less crying kids. But admittedly, that might be a self-inflicted wound. Disney has raised prices very high. But we can see a similar trend at Europa Park, which is the second most popular theme park in Europe. And here, wait times are down between 16 and 19% from the post-COVID peak, and are now below the 2019 levels. So it's clear the revenge travel has been satiated and the cost of living pressures are starting to hit home. But what about China? They haven't recovered yet, which is true. But don't get too excited about China in the near term for a few reasons. Firstly, the Chinese economy is weak. Consumers aren't spending, they're worried about their incomes and declining property prices. Secondly, the travel preferences for the Chinese population is changing. There's now a preference for domestic travel, and staycations are a new phenomenon in China. And secondly, younger tourists no longer have the same interest in the group travel that their parents experienced. And finally, a key motivation for Chinese tourists was to spend money on luxury goods. And that motivation has been blunted as a lot of duty-free shops have been able to open at home, such as in Hainan Island, known as China's Hawaii. And bringing it back home, the excess in Australia has been extreme. You can see that new loans for travel and holidays is well above pre-COVID levels, and this comes with much higher interest rates, which is clearly not sustainable. International airfares are also well above the pre-COVID levels and are continuing to rise this year. So as the international travel enters a nosedive, it's Australian airlines that are going to be most impacted. We're going to see competition increase from increased capacity, the weight of public pressure, and once some IPOs are complete. We're also going to see huge capex bills to replace what is one of the oldest fleets globally. And this comes at a time when airfares are set to decline. So, ladies and gentlemen, please fasten your seatbelts because airlines' earnings are entering a descent. But one type of company that can do well in this environment is SiteMinder. And SiteMinder is a software company that produces channel management software for hotels, which allows them to manage their inventory of rooms and prices across hundreds of booking sites globally. So the hotels use the software to maximise their revenue and also lower their costs. So the demand is somewhat counter-cyclical. When times get tough, demand for the software increases, as we saw in the GFC. And SiteMinder has quite a long runway in terms of penetration. There's still over 500,000 hotels that are using Excel spreadsheets to do this, and they've only converted 39,000. Their unit economics are very strong, and we believe they can improve as they roll out more products and features, and SiteMinder will turn cash flow break even over time. So with strong growth and improving profitability, it's a core long-term holding for our fund. Thank you.
Okay, so are we still the lucky country? Absolutely. Are we going to be the luckiest? Well, that's what I'm talking about today. I'm going to talk about the disruptive power of superannuation, how it's distorted the nation, but more importantly, how it actually affects you as individuals. So we need to wind back the clock, firstly, 30 years to when SG contributions first came compulsory. Back then we had a meagre 146 billion in the superannuation system. We now have 3.5 trillion, 23 times the figure. Now that is going to have some significant effect on society. The first thing is around our wealth. Our household wealth has gone from 2.5 trillion to 14 trillion just in the last 20 years. And most importantly, it's actually rocketed us up the charts in terms of wealth per adult globally. We've gone from the ranking of 15th to now 4th in the world in terms of the most wealthy nation on the planet based on wealth per adult. So my shocking prediction, apart from the Broncos winning the NRL, is that we will be the wealthiest country on the planet, wealthiest nation on the planet, and we will go to number one within the next 20 years. Now, it's not rocket science. We talked about compounding with Miller today, the power of compounding. The average member balance will go to 439,000 over the next 20 years. That's more than double. The superannuation pot will more than triple to 9 to 10 trillion from where we are now, 3.5 trillion. So, who cares? What's this all matter? We all know about superannuation, we know the power of compounding, but what's it mean to you? The first thing is if you own an advice business or you own an asset management business, don't sell it. Whatever you do, don't sell the business. If you do want to sell it, we'll probably buy it. But if you don't want to, don't sell it. If you're an advisor or you have an advice asset management business, you must be targeting millennials now. Millennials will have the biggest pool of real assets in superannuation in the world, well, in the history of super in Australia. The reason is I've grown up with super. We've got 12% SG contributions going in for that generation. They're typically dual income households, and they will be the longest living. They'll live into mid-90s as a generation as well. So the compounding effect is enormous. You must target millennials. Forget about Macquarie, superannuation is the millennial millionaires factory. In terms of asset management business, you can be really bad at distribution in asset management. You could have whatever fund you've got now and do nothing, and you'll have 3 times the value of your business. So don't sell it. The second thing is around the property and equity market bears. And let me talk, Christopher gave me a little nod there, Christopher. Now, in terms of property market bears, the often quoted debt to disposable income ratio really gets the Chicken Little's wings a flapping about the outlook for the Australian residential property market. And for good reason, we have borrowed more money, 187% of our disposable income from 110. But one ratio that we never get quoted for some reason is the debt to assets. The explosive growth in our asset pool has meant the debt to assets ratio has gone absolutely nowhere, 16% to 17%. So the problem in Australia with household debt levels is we're not borrowing enough. Now, I'd like to call out a special mention to those of you in the Sydney eastern suburbs because, you know, you're doing a great job for the nation to get that ratio up. In terms of equity market and the outlook for equity market, 30% of flows from super go into the equity market in Australia, domestic equities. So the issue is not about whether the equity market is going to be up in 20 years' time. It will be up. The issue that we have is ASX going to cope with that. Will there be enough companies, or do we have to buy CSL on 100 times earnings? Consumer spending, we're battling around consumer spending. Why is it so resilient? The reason it's so resilient is when you don't have to save, you can spend. So if you've got 12% going to super, you can spend 100% of your income. I mentioned the millennials and how they're going to be a massive cohort in terms of superannuation. They're going to have a massive balance. In 20 years, they're going to start drawing on that balance. And superannuation is going to drive consumption. And superannuation is millennials. So millennials will drive consumption in Australia. So I envisage a future of 20 years where we're all wearing Lululemon activewear. You mentioned avocado toast, acai bowls everywhere, and pursuing life experiences, whatever that is. In terms of monetary policy, it becomes ineffective. If we enter sort of the bizarro world of monetary policy where Superman is bad and everything is opposite. We put interest rates up, that increases people's incomes, increases consumption, and actually drive the economy. If you want to put the brakes on the economy going forward, you actually have to reduce interest rates. And then we saw a recent example. This is not in the mega future. Commonwealth Bank pulled this out of their result around the change in behaviour by cohort. So the 55-year-olds plus are actually spending more. And the reason is they've got more income. And lastly, which is not that surprising to anyone in the room, but industry funds will dominate the honeypot of superannuation. 50% of the honeypot. They'll own 20% of the equity market. They'll deepen the bond market in Australia, which needs deepening. They'll control property values. They'll move together in syndicates to hoover up private assets and private companies. And if you're a listed company and an industry super fund owns your equity and your debt, then what's that mean for the board composition? What's that mean in terms of management? And what's that mean in terms of governance going forward? So that's it. We will go from being the lucky country to the luckiest. We will be the number one in the world. So you do need to worry about some of those distortionary impacts of superannuation. You do need to be aware of some of these opportunities, but what you don't need to be is bearish, so buy Australia.
Andrew, thanks for the tip on my funds management business. I'll be holding on to it for a bit longer. So look, as will be obvious in a second, none of our speakers actually talked before we come up here and give our predictions. One of the themes that's come out today has been inflation and how sticky it is. In fact, most central bankers recently have come out and said to us it's sticky, it's persistent, it's a pain in the backside, we can't get rid of inflation. But these are the same central bankers that said to us lower for longer a little while ago. So, with that in mind, my prediction is this, that we will re-enter a period of low inflation in 2024 and beyond, in contrast to some of the early speakers today. Now, what do I say about that, and why is this a justification, or how do I get the rationale for this? Well, I'll look at history to start with. This chart here shows you a very long history of inflation across Australia, the European, Eurozone, and the US. And as you can see, it's been very, very persistently stuck around 2 to 2.5%. Nothing like this, massive spike we've seen recently. Now, in case you think this is a fluke, let's look longer. Over 20 years, the chart looks remarkably similar, except for a few little peaks and troughs earlier in the 2000s. It's been remarkably stuck between that 2 to 2.5% range. And don't forget that the spike we saw recently took an immense effort. It took COVID, it took global travel bans, and it took central bankers a massive coordinated fiscal stimulus effort to get there. A huge increase in monetary base, huge QE, and with all of that, we finally got inflation. And again, over 30 years, same sort of picture. It's been very, very, very stuck in that band between 2 and 2.5%, and that sort of peak we've seen recently looks like it's coming off pretty aggressively. And don't forget, we've also heard today about the AI boom, and that's going to be a massive productivity boom, let alone when we see quantum computing. Now, what does it mean, and how can you take advantage of this reduction in inflation and possibly interest rates? Well, just as you should never ask a hairdresser whether it's time to get a haircut, you should probably never ask a small cap manager if it's time to be buying small caps. But with that in mind, I looked up our friends at the MSCI who did this great study for me, or for us. For over 50 years, if you go back and look at the performance of small cap equities globally, and compare it to the small cap, to the large cap equities globally, you can see that on the left-hand side there, during periods of low inflation, small caps actually outperform. And the smaller bar on the left-hand side there shows that during periods of high inflation, small caps typically outperform large caps as well. On the right-hand side, you see periods of transition. So during rising CPI, actually large caps outperform as people flock back to safety, defense, liquidity, and so large caps actually tend to win. But in periods of falling inflation, actually small caps tend to outperform again. So if I'm right about CPI falling, interest rates coming back down, it could be a very attractive period for small cap investing. Surprise, surprise. And even more luckily, this is the recent performance of the small caps in Australia versus large caps. And you can see indeed that defensive trait of large caps has held up. So the black line there is the large cap index in Australia. It's performed pretty well over the last 18 months. It's actually given you a positive return. Whereas our friends in micros and small caps have had a really torrid time. People have taken money out of small caps and gone back to defensive stocks, large caps. So not only if we are into a period of low inflation will we see small caps outperform, but on top of that, at the moment, there's a very good opportunity because they've lagged performance of large caps by so much. So to conclude, my prediction is that we are seeing inflation falling off, and I'm getting a smile here about the food situation. And I think that will lead to, I think inflation will fall, and I think rates will come down with it. History generally has supported that view, and I think AI plus, if we get quantum computing, we'll see a dramatic, massive increase in productivity, which will help inflation as well. Small caps often win when we're in a deflationary environment, and there's also a massive performance gap. So with that, thank you very much.
So my shocking prediction for 2024 and beyond is the end of obesity as we know it. That's a bold statement, right? It's a bold statement. It's a little bit of a change of tact on what everyone has spoken about, but every few decades, a medicine comes along that upends the pharmaceutical industry and society at large. We had penicillin in the 40s, we had Prozac in the 80s, in the 90s we had statins, and of course the immuno-oncology drugs of the last decade. And I think there's a very good chance that the anti-obesogenic drugs will go on to become the blockbuster story of the next 10 years and potentially the best-selling drugs of all time. So why is this important? Well, it's important because obesity is the fourth leading cause of death globally. And it's also a risk factor in a range of other diseases, as you can see there. Obesity levels have tripled since 1975, so they're on this inexorably strong trend year after year after year, almost exponential. It's estimated 50% of Americans will be obese by 2030. That translates to about 18% of total medical spend in the US, so we're talking very big numbers. Obesity is actually associated with 200 comorbidities. So if you look at, how do I get back there? Okay, so 200 comorbidities. So the silver lining here is if you can solve the obesity issue, you can solve for so many different burdens on society and improve quality of life. But there's going to be huge winners and losers within this space. Who are the winners? Well, the big winners, we've got Novo Nordisk on the left-hand side. So Novo Nordisk, for those of you who don't know the company, they're actually Europe's biggest company right now. They just took over LVMH as the biggest company in Europe. And this is a company, people think about the big pharma companies, they think of Eli Lilly, they think of Astra, that sort of thing. Third biggest pharma company in the world today is Novo Nordisk. And their key drug, their key revolution, Wegovy, it's a GLP receptor agonist, which means that it suppresses appetite. So unlike previous generations of pharma drugs in this space that sped up your metabolism, people talk about here that they're taking the drug, they actually have to remind themselves that they need to eat. The list price runs at well over $1,000 US per month in the US, and the average weight loss is 15%. Now, they have about a 96% market share in the US. But very soon we're going to see Eli Lilly's Mounjaro, which is expected to get approval for obesity towards the end of this year. The list price for that is $1,000 per month, and the average weight loss is 26%. So really huge numbers. I'm 100 kilos, so that's me losing 26 kilos. So they're incredibly effective drugs The safety profile is extraordinary, and they're potentially 100 billion a year sales by 2035, but I think it will likely be sooner than that. So full disclosure, we own both of these names. We bought Novo Nordisk in 2022 and Eli Lilly in 2021. But the great game changer that's occurred is the select study of 18,000 people that happened, or the results were released just last month. Why was this such a game changer? Why was this so exciting? Well, what they found is that it reduced heart disease, Wegovy, by 20%. Why is that exciting? Because it's going to pave the way to unlocking funding through the US government, through health insurers, through governments globally. So that's an absolute game changer that's going to create winners and losers. Who will the losers be? Well, here's just a few. ResMed, we know well, provides sleep apnea equipment. Since that announcement, stock price has cratered. You've seen various diabetes companies or diabetes device companies that have also seen their prices really deteriorate. Medifast, so companies in the dietary space, the slimming space, they've really got hurt as well. They're going to be some of the losers. But you'll notice at the top we've got WW Weight Watchers. So that's a bit strange. Why Weight Watchers? Why are they up about 80% or so since that announcement? And the reason is very simple. Because earlier in the year, they paid $120 million for an acquisition of a telemedicine company that does one thing and one thing alone, and that's provide prescriptions for people on anti-obesity medication. So if that doesn't tell you that, Weight Watchers, the company that's been extolling the virtues of self-denial, they're pivoting and saying, well, actually, if you just take this pill, then you don't need to do any of that. It's pretty extraordinary times to be living through. Who are the other losers? Well, this is a longer term story to play out. Some of my favourites, I hate to say. But a recent paper by Morgan Stanley, very easy back of the envelope calculations. They said, well, in the studies, the foods that people are most cutting back on that are on these medicines are actually the fattiest and the highest in sugar, the unhealthiest foods, the fast foods and the sugary drinks. So with their estimate that by 2035, 24 million, so that's about 10% of the adult US population, will be on these drugs. So it's a massive number. And you get an average 20% average calorie reduction. And that's going to translate to a 2 to 3% reduction in expenditure for these companies. So, it's definitely some very exciting times ahead. I think fortunes are going to be made, fortunes are going to be lost, and certainly lives for many, many individuals will be improved greatly. Thank you.